Hello, this lesson is on investment principle number 13, which is reinvest capital gains and dividends. And this is part 2 of the 4 parts regarding shares. Remember, the key in investing in mutual funds long term is accumulating shares, not necessarily focusing on the dollar value of your accounts. That's what gets clients in trouble. So one of the 4 ways to essentially automagically attain or accumulate more shares is to have the capital gains and the dividends of said mutual fund reinvested automatically to buy more shares. Now, there's a couple things about this. First of all, 99.99% of all clients and advisors have this turned on by default. In fact, it is turned on by default in every fund company I've ever heard of, unless the client explicitly states or indicates, no, I want the capital gains and dividends, sent to me when they're paid out. And that's the way it should be, meaning that it should reinvest the way it is now. The challenge is that clients don't even really grasp how powerful it is because it's automatic. And advisors don't talk about it because, we just have the capital gains and dividends reinvested automatically. It's no big deal. It's a huge deal, okay? First of all, the capital gains and dividends, as you probably already know, of course, is the dividends paid out by the underlying companies that the mutual fund managers own, which means we, the customers, own, and it's the capital gains generated when the managers sell a company stock for more than they bought it for. Within the fund, that generates a capital gain. It's a gain in capital, and then that gets paid out proportionally. It's paid out per share. So that's why, again, back to shares. The more shares you own, the better. So in this case, I'm not talking about capital gains of a individual particular client selling a mutual fund, selling some of their mutual fund shares, and then getting a return. That's just in case you're wondering. So here's some things that we, I think, as advisors take for granted that clients aren't even aware of, and they should be aware of because of how fantastic the automatic and reinvesting of capital gains and dividends are. Number 1, when they're reinvested without any sales charge, right? There's no sales charge, regardless of what kind of, if you have F share, C share, A share, or no B share back in the day, it doesn't matter whatever share class you have or a fee-based or a commission account, all that's irrelevant is when the mutual fund generates a dividend and or a capital gain, and you've got set to reinvest, which most everyone does, it's buying you more of those same mutual fund shares at absolutely no cost. Now, of course, you, the advisor, don't get paid on it on that moment. I mean, you get a trail, but on that moment you don't. That one feature alone is that's amazing. That's fantastical, okay? Second thing, it's incredible. Mutual funds are very simple. They're the greatest investment in the history of the human race because they invest, in fact, in the human race. That's what people don't realize. That's what mutual funds are doing. They're investing in human ingenuity, right? Publicly traded companies around the world. They're also the most transparent, and I think really ultimately the simplest, but they are sometimes a little bit more complicated than people think. Not a tremendous amount of complicated, but here's what I mean. A mutual fund and the market, the economy, well, the market, I should say, not the economy, can have a poor year and yet still generate a capital gain and or dividend and buy more shares. How can the fund do negative 10% and then I still generate a dividend? That especially people ask that when they have a non-qualified account, meaning an account that is not in some form of tax shelter, like IRA, 401k, what have you. Then they have to pay taxes on those dividends and capital gains, right? So how can the fund have lost 10% and I still have to pay taxes? Because the fund also made money, believe it or not. And that's why at the end of a bad year, you could end up with more shares of a given fund than the beginning of the year, even though the fund on paper in value went down and you didn't add any money and yet you have more shares. So that's why I've always focused clients on the shares, not on the dollar value. Dollar value goes up and down. You're going to drive yourself crazy. You got to focus. Don't focus on the rent you can charge on any given month or even any given year on your rental properties. That's going to go up and down. Real estate goes up and down. The market goes up and down. what you focus on is a number of real estate properties you own, right? The more you have long-term, the better off your retirement will be. If that's how you want to retire, mutual funds are better, but you get the analogy. Who cares if you're 47 years old and you're going to retire at 65, who cares how much rent you can charge this year? Maybe you're expecting $1,000 a unit, you can only charge $850 because of the market. Who cares? The point is you're generating a business income to buy more rental properties. That's how shares are. So back to the point. How can that happen? Well, because the two things are unlinked. Well, they're connected, but they're not directly connected. So if you have a mutual fund beginning of the year, if the 150 companies that are in the mutual fund as a whole go down, they go down. In other words, and by the way, that's their stock value going down, which is also artificial, right? As a quick aside, because it's related to this, the whole market can go down. Let's call it the American market. Let's just use the American stock market. Can go down in value on paper. But most of the companies in question could have all been profitable and pay a boatload of dividends. Because to some degree, the shorter term you go, the more a publicly traded company's stock value is subject to non-rational forces. Meaning it's like the whole Bitcoin thing that's happening right now. Bitcoin is actually a fantastic currency, or a fantastic, well, it is a currency, a trading mechanism. But its current value is way overinflated because it's human nature, right? And it goes in both directions, right? When people are fearful, they get even more fearful and they sell even more, and there's more negative news and they sell even more. So my point is that you could take, let's keep it simple. Let's say you take 10 companies in a bad market just to observe them. When every one of them on paper, the stock value went down, right? Instead of $100, it's 95, and et cetera, went down. And yet theoretically, every single company could have actually had a great year and made money. But the problem is because they're inside of this larger bubble that's going down, this larger group consciousness that's happening where most people are freaking out for whatever reason. Just pick your poison. There's 1,000 examples of it. That it pushes the stock price down because people are selling the stock. But the actual company that the stock represents is doing great. So back to the mutual fund example. You got a mutual fund, 150 companies at the beginning of the year. Then you look at the same same stocks at the end of the year, and the overall value of the 150 on paper, the stock value went down. So now when you do the mathematics of this many shares times the share price of that mutual fund, it's down. You're like, wow, I had 100,000, now I have 85. On paper, if you were to sell today, meaning December 31st in my example, yes, you would have 85,000. And if you had bought the shares at the beginning of the year, it would have cost you 100. If you want to equate that to losing 15,000, be my guest, but that's completely squirrely. That's not how. It's like buying a Beanie Baby collection on eBay for $1,000. A year later, you go back on eBay just for kicks to check what the price would be for something like that, and it's only $850. You don't go, oh my gosh, I lost $150. No, you still have the same physical Beanie Babies sitting in your bedroom, right? A year later. It's just if you were to sell them right now, you probably would get $850 and you paid $1,000 for it. But that's your choice to sell. No one's forcing you to sell. Just hold on to the Beanie Baby. No one came to your house and took 15% of your Beanie Babies, right? So I'm going on the side here. So now, let's go. Let me go finish this thought about capital gains and dividends. So end of the year, in my example, 100,000 goes to 85,000 on paper. The value of the underlying stocks, 150 stocks in this given mutual fund, it's just an example, is $15,000 less, which, by the way, that doesn't mean all the 150,000 companies lost an average of 15%. It could have been a couple of big ones they had maybe 1, 2, 3, 4% holdings, and it lost a lot. Doesn't matter. It doesn't really matter. Here's my point, though. As I said before, it's possible out of those 150 companies, a boatload of them actually paid dividends. Sure, their stock value on paper went down, but the companies themselves have good earnings, so they pay dividends, right? So guess what the fund does? The mutual fund here, the sample mutual fund, it pays the dividend. It's also possible to even get a capital gain. It's usually less likely if you have a really bad year, it's less likely you'll have a capital gain, but you could, meaning the fund managers during this terrible year still could have sold a stock of a given company, and maybe they bought the company a long time ago, so even selling it now in a down year, it ended up being a capital gain. In other words, they sold it for more than what they bought it 11 years for ago. Make sense? So that's how you can have a mutual fund that on paper goes down in value, but yet it's still, the fund itself generates and pays out a capital gain and a dividend, which means, now here's the kicker. Okay? Now that you've got that concept and you've got the first concept, which is capital gains and dividends are automatically reinvested and there's no sales charge. Okay, listen to this. Check this out. I tell my clients, listen, I don't really want you to have a down year because I know it's stressful. But you know as well as I know from a rational standpoint, this is after the clients are educated, we actually kind of want a down year. Because you're still an accumulator, you're still saving, you're still building up your nest egg, right? You're still building up your golden goose. You're buying more. Because I insist every client gets on a monthly draft. That's another lesson. So what happens is, we actually want a down year because now the share value, the share price is down. You want it cheap. You want to buy them cheap, right? You want to buy them expensive or cheap. You want to buy them cheap, so you want a down year, right? If you're buying a new car, you actually want the car market to go down so that the car manufacturers are selling them cheap, right? It's common sense. Here's the kicker about if you have that perfect storm of a down year and a good number of the companies in the mutual fund have done well and pay a dividend. That's a mouthful, but you get my point. If it doesn't always happen, but if you have a down year in the market and your fund, but the fund pays dividends, take a guess what those dividends, and they're reinvested. Are they and so now the dividends paid out, and maybe some capital gains if you're fortunate, are paid out, and they're reinvesting in the fund. Really what it means is they're buying more shares of the same fund. And what's the share price comparatively? Low. See, everyone loves an up year, but here's the crazy, like this year, this is being doing in December 2017, this video. Crazy year. The ICA has done 20% return, which is a blue chip fund, 20% return, which by the way, the ICA since 1936 has paid a dividend every single year, never missed a dividend, which means that they held stocks in their fund regardless of World War II, World War II, Vietnam, Korea, all the stuff. You can pick your poison on what the tragedy was. Every year it paid a dividend, which means they held companies in the worst possible years. They still had a few companies that paid a dividend, which therefore, because the only way the fund pays a dividend is the companies pay. The fund itself doesn't actually pay a dividend. It's only paying a dividend if the underlying stock or stocks pay dividend. That's another side. It's not like the board of directors of a mutual fund just declares a dividend. It's based on, so if mutual fund owns 150 stocks, I don't like saying stocks because it's companies, but you get the point, and none of them pay a dividend, there would be no dividend. Please understand that, okay? So, again, this is another thing. I don't want to get too complicated with clients, but say, look, in a down year, I shouldn't say the only thing, the two things you want to hope for. One is that you have extra money that you can buy more shares. That's the most important. The second one is, let's hope that by the year end, that fund pays out I know, because every client of mine's in the ICA, so I know, or pretty much know, that every client's going to get a dividend payout. But when we're during the year starting to see it's a bad year, one of the things I say, listen, one thing we want to hope for is that by the year's end, because most equity funds only pay dividends. Well, that's not true. Anyway, it doesn't matter. Some of them pay quarterly, but I tell them, look, by a year's end, we want to make sure some dividends got paid out, because then we're cool, okay? Because then we actually made a profit, if you will, in my opinion, because we bought really, really cheap. See, those dividends capital gains going back in a down year are, again, to repeat myself, are not only going in with no sales charge or buying the shares without a sales charge, they're also buying those shares that are comparatively cheap shares right now compared to the general timeline. Right? Because it's a down year. That's what a down year means. And I sell them on that so that when it happens, they're like, hey, I know that you don't think the year was great. First of all, you didn't lose any shares, right? No matter how bad the market was, 30% drop, let's say, you didn't lose any shares. We have the same number of rental properties. You just can't charge $1,000 a unit anymore. You can only charge $700, as an example, as a metaphor. And I tell my clients this so many times that I know the rental analogy, Michael, but they get it. So that's it. Those are the benefits of capital gains and dividends reinvested. It's really three. The third one being a combination of the first two. The first one is no upfront sales charge, or no sales charge at all of any form, not even a contingent deferred sales charge. No sales charge whatsoever. Number two is that capital gains and dividends can be paid out in a down year, even when it looks like on paper that the fund is down. And three, when you combine those two things together, which is you can kind of, you got to be careful how you say is. I was going to say how you can salvage a down year, but the problem with saying that is that I don't actually agree that it was. There's nothing that needs to be salvaged. It was fine. The share price just went up and down, but you didn't lose shares. So don't oversell that third one, because then it makes it look like you're admitting that it was a bad thing that the year went down. But I would mention, say, listen, one of the things I want you to understand though, let me say this way, one of the actual benefits of the year being down is without you even adding money, hopefully they did, but if you didn't even add any money, you just automatically increased your shares at a tremendous discount, because you didn't pay a sales charge, and the shares that got reinvested in capital gains, the shares that you bought by reinvesting dividends and capital gains were bought at a low price. That's one of the things that you really want to get across to clients. Those are the three takeaways: automatic capital gains and dividends to buy more shares.